Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. For those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I would love to get my license back one day. I left the industry as I could not stand the owner of the business. I got no interest in sales. But my passion is to help people, not to sell various managed funds or insurance products. These days, I work in tax. What I want to address today is, a misconception around superannuation and what people in the news are calling an inheritance tax. Before we get into the nitty-gritty, I need to emphasize, in Australia, we do not have an inheritance tax. I've got a whole super series that you guys can watch. The videos are being released progressively over the year, so make sure to stay tuned to the channel if you want to know more about super specifically. And episode 3, we're talking about how wealthy individuals get around the so-called inheritance tax. Now, the first 3 videos are out, so make sure to watch them. So why do people say we have an inheritance tax when it comes to super? The reason for that is because there are different classification of the funds being held within your fund. You've got tax-free, taxable taxed, and taxable untaxed. Taxable untaxed is very limited and pretty much only limited to specific defined benefit funds, so we'll ignore that one for now. Tax-free portion of your super balance comes from your non-concessional contributions, i.e. your after-tax contributions, and the taxable tax comes from your concessional contributions, the pre-tax contributions to super. There are 2 parts to this, and it all comes down to dependency. When it comes to super, there are 2 types of dependency that play a role. There is SIS dependency, and then there's tax dependency. When I say SIS, that refers to super law. It's the Superannuation Industry Supervision Act, and that gets shortened to SIS. So when you hear me say SIS, I'm talking about super law. I'll get into the 2 different types of dependency in a bit, but I'm sure what you want to know more is the tax rate. So when it comes to the tax-free portion of your super balance, it's always going to be tax-free. For the taxable tax portion, that will be tax-free to tax dependent, and it will be taxed at 17%. That's 15% plus 2% Medicaid levy for non-tax dependents. If you want to make sure that whoever receives a super balance pays no tax at all, there is a strategy called the recontribution strategy. And this is as it sounds. You pull money out of your account and then you recontribute it to change the classification of funds from being taxable tax to tax-free. If this is something you want to do, I highly recommend contacting an advisor, as this is more of an advanced strategy and it's important to get proper advice in order to make sure you don't accidentally break the laws and exceed caps. Now that you do know what the tax implications are, let's talk about the 2 different types of dependents. What is the difference between an SIS dependent and a tax dependent? In order to be a beneficiary of someone's superannuation balance, they need to be an SIS dependent. If you don't meet this condition, then you'll not be able to receive the money and the nomination will be invalid, leaving it up to the trustees of the fund to decide who to pay it out to. In order to be a SIS dependent, you need to either be the spouse or de facto spouse of the deceased, a child of the deceased, any age, or a person in an interdependency relationship with the deceased. I have seen in the past where a client wants to nominate their father and their brother. That would have been an invalid nomination, as both of these are not SIS dependents. There is one other category I haven't mentioned yet that can receive a super, and that's your estate. So if you want to pay out your super to someone that's not any of those 3 above categories, nominating it to the estate is basically the only option. Once you've determined whether or not a beneficiary of the fund is an SIS dependent, are they a tax dependent? The requirements to be a tax law dependent are their spouse or de facto spouse, a former spouse or de facto spouse, a child of the deceased under age 18, in an interdependency relationship with the deceased, or any other person dependent on the deceased. Now, you notice there are a few things that line up with SIS dependency and some that don't. So let's go through it. So a spouse can receive the super. They also don't have to pay tax whatsoever on the balance they receive, whether it's fully taxable taxed or tax-free. A former spouse is technically not an SIS dependent. If they are able to meet interdependency laws, they can receive the benefit. Otherwise, that would be an invalid beneficiary. If they do manage to get past the SIS rules, they will also receive the balance tax-free. Next, we come to children. So all children can receive the super balance, but only those under the age of 18 will get it tax-free. Any children of the deceased over age 18 will have to pay tax that is described earlier in the video. That is, unless they convince the tax office that they are in an interdependent relationship or another dependent relationship. People with interdependent relationships, they can receive the super balance and they also receive it tax-free. Finally, there's the other tax law beneficiary, which says any person dependent on the deceased. What does this mean? This does not actually exist in SIS law. So firstly, the beneficiary needs to meet SIS dependency rules. But the other type of dependency is usually described as financial dependency. Now, I'm not going to recommend this, but I have heard experts say that if the deceased had paid money to the beneficiary every month, regardless of the amount, let's say they sent them $500, but they themselves earn 10 grand a month, it would still be considered a financial tax law dependent. Now, I can't verify whether this is true, but it'll be interesting if this loophole actually works. As I said at the start of the video, I have a full super course coming out progressively on the channel. If you want to know more, make sure to subscribe and keep an eye on the videos as they come out. Hopefully I've been able to help you better understand the difference between SIS dependency and tax law dependency, and why some people are mistaken in believing we have something called an inheritance tax when we clearly don't. If you have any more questions, please feel free to drop a comment below and I'll answer it if I can. Thank you guys so much for watching, and I'll see you on the next one.